Okay, good morning, good afternoon, esteemed guests. Without further ado, I will go straight into the presentation of the two key external uncertainties that we face today, which has to do with the U.S. tariffs as well as the geopolitical situation. I have three key themes, which basically discusses the geopolitical conflicts and how it is aligned with tariff uncertainties. And then I will go on to talk about the domestic economic trajectory as well as the financial market expectations. So, in terms of overall GDP growth, we have tempered our GDP growth forecast for Malaysia. So, initially for 2025, we were expecting GDP growth in excess of 5%, and we have recently downgraded that to 4.4%. It is a downgrade, but we also have to bear in mind it is not completely disastrous against the context that we had GDP growth of around 3.7%, not so far off. And I think anything above 4% or close to the long-term average of about 4.5% in Malaysia is definitely not something that is really low in terms of the overall trends of GDP growth. We can also see that several other economies in Asia, in particular China, will also be looking at a moderation in overall GDP growth rates, and the same can be said for the rest of the world. Essentially, trade protectionism and tariffs is a beggar thy neighbor policy, and that will eventually slice off overall GDP growth in the region of half to 1%. And that reduction in GDP growth is not just going to occur in 2025, it will occur and continue in 2026. And given that tariffs are now expected to remain structural at a bare minimum of 10% over the long term, it will continue to have ramifications on GDP growth in several years ahead. Okay, for the US, the unemployment rate has actually increased, but at the same time, due to the overall level of steady wages and the strength of consumer spending, we have not been able to see a major change in the Fed's stance on its interest rates. So one of the greatest frustrations that financial markets have experienced is, of course, the fact that we had several false starts in terms of expecting a US rate cut, but that has actually yet to happen. And I think one of the challenges that is being faced now is, of course, the encroachment of politics into independent central banking in the US. With regards to the overall economy in Europe, you can also see that the recovery has been very, very gradual and is still slightly below the pre-pandemic levels that we have seen. And at the same time, we have seen inflation fall below, but the reduction in inflation, as you can see, is not very drastic, it's not major. And because of that, that has kind of stayed the hand of the ECB, has not been able to cut interest rates too frequently and by too large a margin. Next, in terms of the overall GDP growth situation, you can see that the GDP growth level is still largely on par within China. At the moment, it is relying quite a lot on fiscal expenditures to essentially maintain the overall level of spending. And in terms of the overall level of exports, as you can see over here, it is still largely on par because there was a lot of front-loading activity in expectation of the tariffs that are incoming by the US. And that has, of course, seen somewhat artificially propped up exports as well as consumer spending. So it is difficult to say how long this will last, especially in view of the structural economic deficiencies, particularly stemming from the property market and the impact that it may have on NPLs in China. Economic sentiment as a result has suffered quite a lot in China. As you can see from the chart on the left, the overall real estate climate as well as consumer confidence has stayed very weak. In fact, it has stayed even weaker than what it was then at the pandemic level. The overall real estate climate has improved only marginally. So as we know, with regards to any asset bubble, it can take a very, very long time to recover from. And a case in point would be, of course, the financial crisis that we have seen in Japan in the past and how it has continued to plague the Japanese economy even up to today. In terms of the overall trade policy uncertainties as well as geopolitical risks, they are weighing on the economic outlook in 2025. But in this slide, I would like to address one common notion that geopolitical risks will tend to lead to an increase in oil prices and whether that will have an impact on inflation. So overall, we can see that US trade policy has caused a gyration in the geopolitical risk index. But at the same time, we have also seen that the overall level of the Brent crude oil price has remained pretty much contained. And this is premised on the fact that the US has released a lot of its strategic reserves. So in the absence of the OPEC Plus being able to control oil prices, it almost appears as if the US has taken the mantle of that role to basically have a very large influence on the overall direction of oil prices. And given that, we can expect that the oil prices are likely to remain low, as indicated by futures pricing. And that will also have an impact on the expectation that inflation will likely remain pretty muted. It will remain muted globally. And on top of that, in terms of overall logistics costs, we have also yet to see any flare up like what we did in the past during, for example, the Houthi rebels' Red Sea aggression, as well as during the pre-pandemic level. So fortunately, we have some input cost levels which are pretty much contained. And I think that would, of course, be very helpful for central bank policy flexibility going forward. So we still do believe that, globally, we should see easing liquidity and monetary conditions, and inflation is not going to be an extreme factor that we need to worry about too much. In terms of the overall global seasonally adjusted purchasing managers index, we can see over here that Asia in particular has seen a very sharp and major decline, and that is premised on the fact that Asia remains a very important exporting region. And similarly, that has affected Malaysia, but I think in Malaysia's case, we have not seen a drop that was as sharp as we have seen in the other ASEAN economies. Regional export growth has inched up very, very slightly, but you can see that there has been differences in performance across the various economies. So for example, South Korea, because of their specific focus on certain kinds of semiconductor chips, has not done very well in terms of its overall export growth level. And I think in the meantime, we can see overall export growth still remains, I would say, not advancing very aggressively, but you can see there is still pretty much below the 5-year average level. So still, we need a lot of room to improve on that aspect. So when we did the long-term study of global average US tariff rates, you can see that in the case of the US, they have been implementing or imposing tariff rates on average of about 2.7% since 1989. And in 2022, that actually dropped to 1.5%. So as what Mr. Arshad has mentioned, 25% is the figure that will stand out very clearly in our minds today, and we will assess what are the potential costs of having that kind of 25% level of tariffs. But I think overall, we are definitely moving into a world where even a 10% baseline tariff is actually significantly above long-term historical averages. So in July, based on the latest data we have received so far, Trump has issued letters to 22 countries. And of these 22 countries, I would say it demonstrates that there is some hope that there will be continued tariff negotiations. So overall direction, as you can see from this chart, is towards lower tariffs over time. About 59% of countries got reduced tariff rates so far as of today. So Trump's new tariffs will continue to target the trade imbalance with ASEAN. So I think there are many reasons why Trump has imposed tariffs. Apart from trade, there are geopolitical reasons as well. But as long as the trade deficit of the US with China and ASEAN remains at these levels, it is not going to stop anytime soon. It's not going to be just a 2025 occasion. It is going to be lasting for several years to come. And from what we have seen in the past, when the US did impose tariffs, there were actually very marked declines in the overall trade deficits. For example, what we have seen after 2019, there is a demonstration that there is this ongoing perceived belief, even in the US, that tariffs can actually help make their country great again. So these inflationary trends are expected to persist. As I mentioned just now, logistic costs as well as oil prices, they have declined. So all is not lost. Low inflation basically means that the monetary policy lever is still available to present counter-cyclical policy to help support GDP growth in the region. So globally, we have seen that the ECB so far has led the easing cycle. And of course, Malaysia has cut the OPR to 2.75% in July. And we believe that based on the range of the interest rates that Malaysia has had in the past, there is still significant policy flexibility for the country to further ease monetary policy over time. The US will also be expected to ease monetary policy. So we have calculated the spread between the Fed rate and the inflation rate as represented by the PCE indicator. And the spread suggests that there is further room for rate cuts. As of mid-year in 2025, the spread was slightly over 2%, but over the long term, the spread tends to be around 1%. So this roughly corresponds with consensus expectations that by 2026, we could be looking at potentially 4 to 5 interest rate cuts in the US. So even if there were additional rate cuts in Malaysia in the region of 1 to 2, we believe that because the US rate cut will be far greater than potential easing in Malaysia, we expect this to support and reinforce the ringgit's strength. So from this chart, it illustrates that while there has been an overall decline in exports, we have not yet actually seen a very significant volatility, especially as of the last 2 years. That volatility has eased quite a lot. But of course, by the second half of the year, in the absence of the front loading of exports, we should expect a continued decline in the overall technology cycle. But we can see a lot of domestic support for growth. In particular, if you look at the overall total approved investments between 2021 until to date, it has averaged slightly above 300 billion ringgit as compared to the past, where it was on average about 200 billion ringgit. So we can actually see a very major structural change in terms of the overall investment level. And that is further reinforced and supported by this data point on the right, where the gross fixed capital formation in Malaysia has remained elevated. And that was a strong driver which has also kept the overall Malaysian GDP growth elevated. And like what I mentioned just now, despite the external uncertainties and headwinds, we can safely say that Malaysia's GDP growth still remains very close to the overall long-term average. So what has been supporting that growth? Of course, robust consumption from the domestic economy and strength in tourism has backed domestic demand. And in particular, we also note that Malaysia's overall tourism sector has strengthened quite a lot. In fact, it is now stronger than the pre-pandemic average. And the pre-pandemic average is marked by the dotted lines over here that you see in this chart. We expect price pressures to remain contained despite the SST increase. So although we have domestic factors which may push up the SST factors, as I explained earlier, there are downward pressures on global commodity prices as well as logistics costs. I will now discuss the financial markets. So in terms of the expected interest rate cuts that are being priced in over the next 24 months, we are expecting another further 3 to 4 US interest rate cuts at the very minimum, although there is the potential that it could go to as far as 5 rate cuts going forward. So in the overall context, we believe that in 2026, you're going to see the greatest number of interest rate cuts amongst by the US amongst the G3 central banks. The interest rate cut scenario has also evolved over time, and this gives you a general indication that in March 2025, expectations were actually a lot lower. And the reason why we can expect that wide range in interest rate cuts is very well depicted by this chart, where you can see that even on a monthly basis from March to April to May and June, you can actually see that rate cut expectations have had a range of around 50 basis points on average. So that gives you that uncertainty factor of at least 50 basis points in terms of being able to predict US rate cuts. But I think more importantly would be how have the US interest rate and the global interest rate expectations filtered down to the bond markets. And we can see from this chart over here, gladly, the overall Asian bond yields have actually shown a slight decline over the last 2 years, as opposed to the general increase in G3 bond yields. So that gives you a very clear direction of the potential strategic asset allocation that can be adopted. And I think that is particularly important in view of the fact that there are increasing concerns of de-dollarization, increasing concerns of the dumping of US treasuries, as well as the increasing concerns that US militarization may lead to a much larger US fiscal deficit over time. So the yield curve so far has shifted lower in the first half of 2025, and we do expect dovish sentiment in the interest rate markets to continue shifting US Treasury yields lower. And I think the other important point to note about the difference between the Malaysian and the US yield curve is that, again, the expectations in the US yield curve remain very choppy and highly volatile, which is, of course, illustrated by the fact that in the first half of 2024, there was actually an inverted yield curve, and now the yield curve has actually steepened quite substantially. So if you were actually caught on the wrong side of the trade, you can imagine where the portfolio will be right now. So I think for the US market, basically hedging remains a very important strategy as compared to relative stability in the MGS yield curve. One good news that we have observed in the financial markets is that the bond volatility, equities volatility, and emerging market bond spreads have not demonstrated patterns of volatility that are historically alarming. So you can see, despite the trade policy gyrations that we have seen coming out of the US, the overall emerging market bond spread was actually largely in line with historical events, such as the previous US election. And in terms of the overall increase in the spread, it also was more or less in line with what happened when the Silicon Valley Bank collapsed. And in terms of quantifying that overall spread change, in terms of the overall bond market, it has been within a pretty manageable 50 to 75 basis points in terms of the overall volatility levels. Of course, that depends on which part of the credit curve you're on, whether you're on the high yield space or the investment grade space. But I think generally, these emanations from the US in terms of trade policy has been pretty much taken by the market in stride. Okay, so the MGS yield curve continues to shift lower. And I think in terms of the overall MGS US Treasury yield differential, as you can see, that there's been quite a lot of volatility in the past. And I think despite the fact that the yield differential has not been in favor of the MGS yields, you can actually see that the Malaysian ringgit has still appreciated on a year-to-date level. And our in-house econometric models also suggest that the MGS US Treasury yield differential or the interest rate differential has a very, very limited impact in terms of causality on the ringgit. In terms of overall fund flows, we have seen net foreign equity flows. It's been largely outflows for most of 2025. And then when we went into June, there was a tiny spark of hope that there'll be more inflows, but then in July there were outflows again. But fortunately, within the bond market, we have actually seen a lot more consistent inflows, and actually the inflows are very, very substantial, as you can see from this chart. And you can see the percentage of foreign holdings of government bonds in Malaysia is also improving to normalized levels that we have seen in the past. So, as what I mentioned just now, ringgit has performed well. And I think part of that good performance has been to kind of close the gap of the historical correlation between the dollar index as well as the USD MYR. So I would say, in a way, this overall appreciation of the ringgit is well expected and is pretty much aligned, although between 2023 and 2024, we didn't see that alignment. So it's a good thing that we're seeing that alignment once again. So with that, I'd like to summarize the key takeaways. We will discuss the developing geopolitical conflicts in greater detail. We have a esteemed set of panelists today to discuss some of these major issues. But I think overall, while the trade uncertainty remains an overarching theme, there will still be available policy measures through monetary policy to help manage the situation. With that, thank you. I'll pass the floor back to our MC.